During this journey of discovering different investing processes, we felt that some of the tools are lacking in the Indian industry, and we felt that if these tools were available for us, it would have made our investing process much simpler and smoother. So, with that as the origination point, we tried to build some of the tools and share it with the larger DIY community in India. And one such tool that we're going to demonstrate today is the backtesting engine, which helps investors identify the right set of indices and compare it against benchmark and take more evidence-based, data-driven decisions. So that's the whole objective of this tool. So before I begin about this backtesting engine, I would wanted to share a small description of what are the pitfalls that one usually encounters while investing, and how do we avoid these pitfalls. What is the right kind of framework one should develop while evaluating different funds? When I say funds, these can be mutual funds, this can be PMS, this can be the indices in general, or this can be any strategy. So the backtesting tool is agnostic to the kind of strategy that you would want to compare. But for a moment, at this point, we only are using it to compare indices at this point of time. But later, even the mutual fund data can also be uploaded. Maybe even small cases or PMS data can be also uploaded to compare. Now, let me share my screen and walk you through the process that we wanted to share. And then later, Deepak will be walking you through the backtesting engine. I hope my screen is visible, Deepak. Yeah, cool. So first, I wanted to start with what are the common pitfalls that usually people have while selecting funds. And these pitfalls sometimes are human-driven, and also sometimes because the platforms themselves are pushing us to think in certain direction. The most common pitfall that we've encountered is people only look at the recent last 1 or 2 years of performance and arriving at the right fund or an index to invest on. This is called as recency bias, and we should not just look at the last 1 or 2 or maybe even 6 or 3 months of data to arrive at a conclusion. We should actually look at the longer time frame to come to a conclusion of whether to invest in a particular fund or an index. The second kind of pitfall that usually investors fall is on cherry picking the time periods. Again, this can be investor driven, but also can be sometimes the platform driven or the salesman driven kind of problem also. Like, people usually show the best performance by picking the starting date as from the COVID crash till, let's say, till before the Russia-Ukraine crisis in 2022. So if you looked at the time period between 2020 March and 2022 April, the returns would have been fantastic. But what if you change the time period from 2019 December to 2022 October? Then the results would have been different. So cherry picking time period is also another bias that investors usually have, knowingly or unknowingly, and especially the expert salesmen try to play around the cherry picking by showing the time period which are favorable to their strategy and show that this is how their strategy has performed. And we should be cognizant of that fact and avoid cherry picking time periods. If you see both recency bias and cherry picking time periods, these two are what we call as framing problems. So if you present the data in a particular frame of reference, then it can cause a bias towards favorably picking that particular time period. So these are the two common problems when it comes to picking a fund based on returns. Then the third kind of pitfall that we usually observe is putting the lens only on returns and obsessing only on the returns as a metric to select a fund. One should also pay heed to the risk, the volatility, the drawdowns of a particular strategy, and then come to a conclusion. Because both returns and risk are like two sides of a same coin. Only obsessing on returns is not good, because if a particular strategy is having high volatility and followed by frequent drawdowns, and it takes larger amount of days to recover, then that might not be a right strategy for you if you are, let's say, a conservative investor. So it is important that we not just obsess on returns, but also take risk also into cognizance. So I've talked about the three pitfalls. Let's see what are the metrics that one should focus, or some kind of a framework that one should develop when evaluating performance of different indices. So I've listed 4 such key metrics. I'll talk about each of them in detail. The first one is, as you're all aware, returns. Everyone who's an investor would want their portfolio to grow, and hence returns are the single largest driver in picking a particular fund. Yes, they are the single largest driver in picking a particular fund, but the way that we'll approach returns should be different. It should not be a static time frame return obsession, but it should be annualized rolling returns. So whenever someone presents you a fund or a strategy and say the particular fund has given a returns of, let's say, 20% over the last 5 years, instead of that, one should ask what were its rolling returns. Now, what are rolling returns? I'll explain it in the next slide. The second, as I mentioned, is risk. Risk is the second dimension of returns, like how volatile or how bumpy the returns are over a period of time. And the third metric then that one should focus is on drawdowns. Think of drawdowns as how steep or what is the worst case scenario that could happen while I'm investing in a particular strategy or an index or a mutual fund. To give a better example, if someone were to say that let's say you're crossing a particular river, and that river on an average has a depth of 4 meters. That 4 meter depth is volatility or standard deviation or risk. But the 4 meters is not same across the entire length. There could be some places where the depth of the river might be 8 meters. At some point of or some points of the length, it might be only 2 meters. But the 8 meters is sufficient for someone to drown. So that 8 meters is nothing but the drawdown or the max that a particular strategy can fall, also represented as the maximum drawdown, the peak to trough. So one should be cognizant of what is the average volatility while investing in a strategy, but also the worst cases that can happen while investing in a particular strategy. And the last metric one should pay heed to is the consistency. Each strategy or a fund or an index have a particular cyclicality, or they work under certain market conditions. So we should know what are the strategy or funds which are cyclical in nature, what are the strategy or funds which are secular in nature, which are agnostic to the time frames, which are agnostic to the market conditions. So picking a true winner is essential, and to pick a true winner, we should know whether this particular strategy or fund is outperforming across market conditions, and this outperformance is statistical significance. So the concepts of what is outperformance, what is statistical significance, again will be touched upon while we show the tool. So briefly, I'll go through what these metrics are. I'll start with rolling returns. Imagine if, let's say, someone were to say that I had invested in a particular, let's say, Nifty 50 during 2020, and by the end of 2025, let's say July, as on today, July 26th, it gave returns of 15% CAGR. Whether that 15% CAGR over the last 5 years, was it the same for everyone? Might not. A person who has invested, let's say, in 2017, their CAGR might be different. Person who was invested in back in 2014, their CAGR might be different. So every time frame has its own return profile. Now, how do we standardize a particular fund and say that on an average, this particular fund gives this much of a returns? Now, there are two things to be noticed here. One, we need to standardize the look back period. A 3-year return period cannot be compared to a 5-year return period, and vice versa. A 5-year return period cannot be compared to a 7-year return period. So if someone is saying that his frame of reference is 5 years, we should compare the same 5-year with another strategy and say whether the particular investment is better or not. Now, again, when we say 5 years, we should not just look back in one particular frame of reference, but take the entire duration and come to a conclusion. So to drive home this point, let me explain the rolling return concept. If you notice the Nifty 50 chart since 1991 till 2026, I have noted down 3 distinct 3-year periods, all same in length. One 3-year period from 1999 to 2002. This is during the dot-com crash. The Nifty index fell by 40%. Then during the peak of GFC, global financial crisis in 2008, from 2007 to 2010, it did not give any returns. It was flat, around 0%. Whereas from 2020 crash, that is during Corona crisis, to 2023, it gave a returns of 100%. So 3 different time frames, or 3 distinct time periods, and 3 distinct returns. Now, how do you categorize, let's say, a particular fund like this? One way to look at is to look at the long-term returns from start till end. The other way to look at the return profile of such a fund is to calculate what are such unique 3-year periods starting from 1991. Let's say if someone had invested 100 rupees in 1991, Jan 1. So we calculate what were the returns till 1994, Jan 1, a 3-year period. Same way, we calculate from Jan 2, 1991 to Jan 2, 1994, and so on and so forth till July 26, 2022 to July 26, 2025. So you have so many such 3-year periods. Now, when you calculate the average value of all such 3-year periods, that's when you arrive at rolling returns. This rolling returns of all such 3-year periods also falls like a normal distribution. And then you calculate the mean value of that normal distribution, that's when you truly arrive at what is a rolling return. That gives you a sense of, if someone were to invest in a particular strategy and stay invested for 3 years, on an average, you would get such and such returns. So that's the outcome or objective of a rolling return is. So instead of looking at a static number, it is always prudent to check the rolling returns. And most of the platforms that we see, I don't want to name those platforms, but most of the investing or trading platforms don't give that rolling return, because that will involve a bit of calculation and explanation from their side to the investors, that this is how it is calculated, what does it mean, and they don't have the patience to explain it, because they are in the process of making you transact, not making you educate. So that's the main fiduciary problem, and fair enough, because they are in their own business of making transactions seamless and smooth. If they make you think on their platform, then you would drop off, which they don't want to, and hence they would want to show the best way of converting you or generating the FOMO by showing you the latest 3 year, latest 5 year returns, that this has grown so much. Now, it needs to be seen, what if we have a severe crash in the next 3 or 5 years, and the latest 3 and 5 years return would be horrible. We'll have to see how would they position then. Maybe then they would switch to a 3 year rolling return period. So leaving that aside, the first metric that I mentioned was rolling returns. This is how it is calculated. Now let's take a look at how do you visually see a rolling return. Like I mentioned, rolling returns is not a static number. Again, rolling returns also will follow a normal distribution. So if you see, this is the rolling returns of Nifty 50 since 2005 till 2025. So each data point represents that particular years. Let's say this data point right now, as we see, where my mouse is hovering, is period from 2005 August 1 to 2008 August 1. So during that time, the Nifty had given an annualized returns of 42%, pretty high numbers. And then it started to correct during the GFC crisis, and since then it has been range bound, anywhere between 0 to 20%. On an average, if you see the dotted line, this is around 13% or 14%. So this is what our Nifty 50 has given in the last 20 years. There are some periods of exuberance, there are some periods of underperformance, but on average, this is the mean performance of a 3 year rolling return of Nifty 50. So this again, visually seeing the rolling returns also helps us, like what are the periods where we feel that it is statistically outperforming, or statistically in the 95th percentile, or statistically it is in the lower 5th percentile. So we'll know what are the right times to enter, or right times to exit, or right times to tone down our investment expectation or change the allocation. All these can be done visually by seeing such rolling returns graph. I don't want to give specifically what to do in different scenarios, but by visually observing this, serious investor would understand what is the right time to invest, what is the right time to exit, etc. So that's the major purpose of looking at the rolling returns graph. Now let's come to the next metric, which is volatility. Volatility is nothing but standard deviation of daily returns. So like we have seen the graph of Nifty 50, it is not a secular straight line just like an FD would look like, where it gives a 7% or 6% straight without any bumpiness. It is bumpy. There are ups and downs. There are periods where, in fact, a decade of consolidation and then a decade of outperformance, and then again consolidation and then outperformance, crashes in between, and then upheavals, etc. So it is never a smooth line. Since it is not a smooth line, there will be deviations, and we want to quantify such deviations. A metric to quantify such deviations is standard deviation or volatility. So higher the number, higher the volatility. Higher the volatility, higher is the bumpiness, and more stress for someone who's investing in such high volatile assets. Someone who's not prone to seeing their portfolio move erratically would be prudent to invest in a low volatile kind of an assets. So volatility is a metric of how much risk one can take. Unfortunately, many of us have been conditioned to think only in terms of returns perspective, because we have a very good benchmark of what the banks give, let's say 7%. So we already have that framing. If someone says that there's a good investment opportunity of 10%, we'll know that, okay, it is a good opportunity because it is better than an FD rate. Now again, most of us of late would also know what the indices would give, like Sensex or Nifty, around 12 to 13%. Again, we are conditioned. Say, let's say if someone gives you an opportunity of 14, 15%, again, you're conditioned because you have a frame. Let's say the FD gives at a particular rate, the current account gives, or a savings account gives at a particular rate, the markets give, indices give a particular rate. So you know, someone immediately tells that this is the kind of returns that you can expect from a particular mutual fund or a PMS or a small case. You can quickly slot and figure out whether it is a good investment or not. But for us, unfortunately, there is no equivalence in the volatility, because all through long, the FDs have no volatility. It is 0%. So we have never been actually exposed to an investment which is volatile. So for us, volatility as a concept doesn't exist. It is always 0%. Now, when we're investing in equity, volatility comes into picture, and volatility is never measured. So if you take into consideration the volatility of Nifty 50, it somewhere is, I'll show that number, is around 20% on average, plus or minus. So what does it mean? It means that a Nifty can move plus or minus 20% by one standard deviation in a particular year. So someone who's faint-hearted that they can't fathom this kind of volatility, they know how much to allocate in this kind of equity asset class. So when you put both this in conjunction, the returns and risk is when you can take a conscious call of whether it is a prudent investment or not. So like we have comparison on returns, we cannot actually quantify or empathize the volatility. So if someone were to say that I have an asset class which is having 20% volatility, we may not be able to comprehend quickly. So in that case, it is always better to compare it against the benchmarks. Let's say if a particular strategy gives 10% returns at 5% volatility, and there's another strategy which gives 10% returns at 20% volatility. So we can then compare, okay, with the same kind of returns, I'm getting at a much lesser volatility. So that's when you can make the comparison and take a more prudent decision of what kind of investments to make. Just like returns, volatility is also not static number. It changes as the times change. So you can see the rolling 1 year volatility of Nifty 50. This is during the peaks of 2005 to 2008. The volatility was spiking. It was almost at the levels of 45-50%, and then it again tapered down. Now, if you see the decade of 2000 to 2020 was relatively flat or low volatile period, and again we saw a spike in volatility during the COVID crash, and then again it fell into its normal range. And if you take the mean of 1 year volatility in the last 20 years, it is somewhere around 20%. Now, if you exclude these outliers, then actually the mean volatility of index would even come down. But nevertheless, this serves as a good purpose to see our benchmark. Where are we in terms of the current volatility? Are we in elevated volatile phases, or are we in low volatile phases? And then we can make our investment decision. The third metric I wanted to talk about is maximum drawdown. Like I mentioned in the previous example of someone crossing a river, let's say the maximum depth of that particular river is equivalent to the max drawdown. So if you were to look at this example of the Nifty 50 chart, in the entire trajectory of Nifty 50, it had its own shares of ups and downs. Some of the downs were brutal. The most brutal down period is what we call it as max drawdown, and that period was this during 2008 global financial crisis, where the markets fell by 60%. So we wanted to show the drawdown across different time periods, and once we visualize these drawdowns, that when we get a flare of understanding of how frequently the markets can fall and to what levels of depth can the markets fall. So it is also called as the underwater plot. So while you see the returns graph, the mirror image of what is the drawdowns that this particular index has gone through its overall journey from 2005 to 2025 is what we have plotted here. So both need to be taken in conjunction, the returns as well as the drawdowns and risk. So this underwater profile, someone needs to carefully observe this. Most of us would intend to invest for a longer period of time, but again, in our hands, the duration is not in our control. We might think that we want to invest for 10 years, 15 years, or 20 years. But let's say the moment we invest and some emergency comes and we have to withdraw our money. And unfortunately, when we wanted to withdraw, the markets corrected by 50%. Then that would be very painful, because within quick short of span of time, we have lost considerable amount of money, and now we are in dire condition to pull out of the market. So that would leave a very bad taste, and investor who exited markets with that kind of experience would never come back. So we should always take the investment decisions, keeping the maximum drawdowns also into consideration, because especially if someone who's deploying their money in lump sums. So if luckily, if let's say you are somewhere in the underwater, or you're investing when the markets are underwater, that are good opportunities. And let's say someone who's investing in peak, maybe you can taper down the kind of investments that you want to make lump sum. Overall, the drawdown profile would give you a better sense of how do you want to invest in the market, whether you want to do it lump sum, whether you do want it in a staggered manner. This gives you a good perspective. So when you combine these three, the returns, the volatility, and the drawdown, then you have a very good tools in your arsenal to have a better framework to deploy your money. And I want to touch upon the last metric that we wanted to show in our tool when you compare different strategies is called as the uh, statistical significance or outperformance or consistency of a particular strategy. Now let's take the case of Nifty 50. Like I mentioned, Nifty 50 has its 3-year rolling return, and the 3-year rolling return across the last 20-year period also follows a normal distribution curve. Let's assume for a moment that this blue colored graph or the normal distribution is of Nifty 50. Now let's say I show a particular mutual fund. Let's call that as A, and that mutual fund also has a 3-year rolling return distribution like this. And then I show another mutual fund. Let's call it as B. Its 3-year rolling return distribution is like this. And let's take another mutual fund C, and its 3-year rolling return distribution like this. So obviously, you would prefer C because the mean returns of C is much different or much larger than the mean returns of Nifty 50, whereas the mean returns of strategy A is very close to mean returns of Nifty A. So you would say, why are you giving me strategy A? It is nothing much different. It is most of the times the returns are just overlapping with Nifty 50, gives something which is actually unique and better than Nifty 50, and hence you would want a strategy which has the return profile starkly different than the Nifty 50 returns. And if you see in the case of Nifty 50, in the case of C, the least returns of the strategy C are in fact better than the highest returns of Nifty 50. So actually, you would want something like this, where the worst of the case of investing in a particular strategy is still better than investing in a particular fund. Even if you take the best case scenario, also we still outperform. So this is the kind of returns that we would want to have, and this is the kind of fund that we want to invest in. So measuring a statistical significance by comparing two strategies and juxtaposing and seeing whether it truly beats a particular strategy or not is something that we'd want to see. And unfortunately, none of these tools would provide because, yeah, I think as I mentioned again, they are not all the platforms are not in the job of educating, but in the job of transacting. So we wanted to provide all these tools in one single platform so that it can help you, and it can help you in making a valued judgment. Now, we are not SEBI registered advisors nor research analysts. Our job is only to provide the tools or the toolkit. Instead of going only with the hammer, that is returns, we wanted to provide all the sets of toolkit like a wrench or a screwdriver, so that you go with the proper toolbox, see in its entirety, and then make a informed judgment. So I would want to hand over to Deepak, who would be continuing and showing the actual tool that we've built.
Okay, thanks, Shekhar. Hi, everyone. Thanks for joining. I know it's lunchtime for you. Bear with us for a few more minutes. I'm now sharing my screen. Do you all see it?
Yep.
Perfect. So this is the landing page. So I just logged in. So you can use your Gmail ID to log into this tool. And once you log in, this is what you will see. Here you have a video. Right now I put one of the YouTube videos that we have already created. But once we finish this session, we will put the recording of this session and replace that with this video. And here are a few instructions about how to use this tool, but I'll now get into how to use this tool. So essentially, the way we thought about this is, like, if you want to backtest a bunch of indices, let's say you have a strategy in mind saying that, okay, let's say I combine index A and index B and index C, right? If I mix them in some proportion, which will eventually add up to 1 or 100%, and compare that with a benchmark, how is my strategy doing, right? So that's why you have this kind of structure here, where you have strategy A on one side and strategy B on the other side. So here you can select the indices that you have in mind, and compare that with one of the indices, or compare that with a benchmark, right? And just to be clear, in this launch, what we've done is we've added all the factor-based indices, right? And some of them we've already covered in our YouTube videos, like value and low vol, and also the familiar benchmarks or the market caps. So Let me show some of the or demonstrate some of the concepts that Shekhar has mentioned, put them into practice through an example. I'll start off with one index, right? Let's say I take value. You can just type value here and you'll see all the indices that are related to value. So I'm going to pick Nifty 500 value 50 here. And since we are looking at Nifty 500 here, I'll compare that with its benchmark, which is Nifty 500. Once you kind of select these indices, you need to configure the weights. Here it's straightforward. You're just selecting one index versus another index, right? A factor index, which is value versus its benchmark. So the weightage is going to be 1, right? If it's anything less than 1, you cannot proceed. So just make sure if you're using multiple indices, then they add up to 1. I'll also share an example of that just to make sure that is clear for you. So once you have this, you click on the run weighted backtest. And this might take a few seconds, but once the traffic hits in, we don't know how long will this take. So I'll just said, this might take a few minutes. So there you go. We have the results. Here is a summary of what you've selected. In case you've selected a bunch of indices, it makes it clear saying that this is what you've selected as weightage, and these are the indices that you're looking at. So Nifty 500 value 50 and Nifty 500. Here it shows the analysis period from 2005 April to 2025 June 30. And at this point, I want to make it clear that the data that is present on this tool is available till end of the last month, which is end of June. First week of August, we're going to add more data. So you can look at data for till end of July. So every month we're going to make sure we're going to upload more data the data is available till the end of last month. So the total number of years we are looking at is 20, slightly above 20 years. So which has a good number of market cycles. And there are few indices which do not have data from 2005. In that case, it will show what are the common dates across these indices. So it could be 2005, sometimes it could be 2009. So just make sure you're looking at this to know where you're starting from. Now, when you look at this, you see that strategy A, which is Nifty 500 value 50. So instead of naming the index, we said weighted strategy A, because this could be a combination of indices. So just keep in mind that the first selection that you've made is strategy A and the second selection that you've made is strategy B. So 17% CAGR versus 14.92%. So there are 2% outperformance here. But like Shekhar mentioned, we're not looking at just a single metric. You don't judge the book by its cover, so you go deep into this, right? So this is the equity curve. You see that the blue line is your weighted strategy A, so Nifty 500 value 50. So it's going, it was underperforming up until the global financial crisis roughly, and then you see it's actually improving over time, and then again it started decelerating, and then again improving. So it's kind of going up and down, up and down. So you can actually see it's being cyclical. And below this is the drawdown chart. So when you look at the CAGR, it looks like it's doing well. But when you see the drawdown chart, that's when you know what is the depth you are getting into, right? So the analogy that Shekhar has talked about, which is you getting into a pool without knowing the depth of that pool, right? So you can actually look at this drawdown chart like a depth of the pool. So here the depth is smaller, here the depth is slightly higher, here it's even worse, right? So it just make sure you think about your risk appetite. So that's what I mean here. So if you are at this point, you've seen that strategy A, which is Nifty 500 value 50, has actually dropped by about 53% compared to its benchmark, which only dropped about 18%. So if you have invested your money into Nifty 500 value 50 in 2010, roughly, in about 3 years, it would have become roughly half of it, right? So which is and if you have the guts to just hold it, then you probably you have to look at the drawdown days to understand how long it takes for the strategy to recover and recover the money that you have invested. So this is the time period it didn't do pretty well. And then again, post Feb 2018, during the COVID crisis, you see it's actually down by minus 60%, versus the benchmark dropping by minus 34%, right? So returns, you can see the equity curve here, drawdowns, right? So as opposed to looking at just one number, it makes sense to look at these charts to understand the lay of land. Then we can look at the daily returns. The idea is not to, overwhelm you, but at a high level you can see, right, how are the fluctuations on a daily basis, right? So you need not get too much into this, but at a high level this is what it looks like. And then these are the return patterns, right? So first we will look at the return patterns, then we'll look at the risk patterns as well. So this graph essentially shows you what were the annual returns. So in 2005, roughly there's a 25% gain. In 2006, there's half of it, and so on, right? So that's where you see the annual returns. Now, let me also show you the monthly returns. So on the extreme right, you see the monthly returns. So there are cases where it was pretty green. So like in May of 2009, there's an increase of the value by 57%. And then there were cases where you lost about minus 27%, right? So if you have to put these numbers into a histogram, that's the middle graph for you. So this shows how many number of months do you have in these return intervals. That's what is this graph telling you. So here as well, you can see how is the benchmark doing versus the strategy that you have in mind. This one is rolling correlations, 1 year rolling correlation. So if this kind of helps you understand if the strategies that you have in mind, let's say you put a bunch of indices on the left and a bunch of indices on the right, and then you compare them. And if it's very close to one, then they are exactly the same, right? Then you probably have to have some unique addition or subtraction to see an edge of one strategy over the other. So here I just want to show you a few controls that you can use to dive deep into this. So for example, here you can, if you want to just check what exactly are the numbers, you can use this zoom button, or you can use this plus symbol to narrow down into that specific period. So I'm now looking at just 2019 mid to the latest, or 2024 mid, right? So you can now actually see clearly the fluctuations in the 1 year rolling correlation. And if you want to get back, you can just click on auto scale and it takes you back to the original screen. Then there are few more options. So let's say you zoom in to this and you want to further see what's happening in the next months. You can use this pan button to scroll and see for different periods how was the rolling correlation, and click on auto scale for you to get back into this. You can also use full screen to look at the individual charts alone. So those are some of the options that you can use to further dive deep into this. You have the same options with other charts as well. So this is rolling Sharpe ratio analysis. So similar to rolling correlation, 1 year rolling correlation, you have 1 year rolling Sharpe ratios. So what is the return? What was the reward per unit of risk that you are taking? That's what is the Sharpe ratio, as you all know. So here we are looking at, again, this is deeply cyclical. There are cases where the Sharpe ratio was higher for value 50 versus the benchmark. Then there were cases it was not doing pretty well. And lastly, we were looking at, in terms of this rolling risk ratios, we have rolling volatility as well. And I think this is one chart that makes it very clear that the volatility of value 50 is quite higher. So if you see pretty much on a 1 year rolling basis, the blue curve seems to be always on the top of the red curve, which is its benchmark. So at any point of time, looks like if you're looking at the last 1 year volatility of that strategy versus its benchmark, it seems to be mostly higher, right? So that's the 1 year rolling volatility. Then we further dive deep into the drawdown numbers. So there are two metrics here that could be of interest to you. One is the maximum drawdown, So minus 66% versus minus 63% of its benchmark. The current drawdown, so as we calculate drawdown for almost every day, and out of all the drawdowns, what was the maximum drawdown is what you're seeing here. The current drawdown is the latest or the recent drawdown, right? And so you can think of these maximum drawdowns as another lens before you kind of make an informed decision. So furthermore metrics, along with max drawdown, you have max drawdown days. This is like you getting into the pool and, kind of you can think of this like how long can you breathe in the pool, right? So that's the number of days that you can withstand this. Interestingly enough, strategy is able to recover in 1339 days, whereas it took 2270 days for strategy B to recover. This is the max drawdown days, by the way. And here are further summaries of the numbers, the volatility, the Sharpe ratio, sorting ratio, the value at risk. So value at risk, you can think of it like, if you put the daily returns on a normal curve, what were the returns at 5 percentile, right? So you're 95% confident that the daily returns of this strategy is always greater than minus 2.63%. That's not a very good number to look at, but that's what the number says. Then you have ROMAD ratio, which is returns over maximum drawdown. So just you have the return, which is the CAGR number upon the max drawdown is what you get as ROMAD ratio. Now is the metric that you want to look at if you are looking at returns, specifically the rolling returns. So these box charts, as they are called, kind of give you the lay of land very clearly, as opposed to looking at just one metric. So it kind of tells you what is the worst case scenario and the best case scenario and an average or the usual scenario, right? Or a typical scenario. So here you can see what was the 3-year rolling return median, mean. So in this case, it seems like median and mean are exactly at the same point, but there could be cases where they are different. Quartile 1, which is 25 percentile. Quartile 3 is 75 percentile. Then you have the max 3-year return. So if you have actually timed it really, really well, then this strategy would give you a 3-year rolling return of 53.5%. If you have timed it, the worst case scenario is minus 22.6%. So notice that here in this case, this is 5-year rolling return. This is 7-year rolling return. These are, you can think of as outliers. There is an upper fence and then there is a max. So upper fence is basically 1.5 times interquartile range is what you add to the median to get what you add to the quartile 3 to get to the upper fence. I think this is where it is getting a little too much, but you can just assume that these are the outliers and this is the upper or upper fence for this box plot. And you also have a 7-year rolling return box chart. So as you can see here, the kind of scenarios that you can have with these strategies are huge, right? So you see the length of this, you could fall anywhere between here and here, but on an average, it is at 16.5%. And on average, the benchmark is doing a 13.5% rolling return. So the larger this box plot is, the more confusing it is for us to make a decision. The smaller it is, the more confident that these returns lie in these margins, right? So obviously, when the time period increases, these box plots kind of compress. So this box plot, if you put them on a timeline, this is how it will look like. As again, you can see the cyclicality here. Sometimes it is doing well, sometimes it is not doing well. And in one of our videos, we did talk about value being highly cyclical as a factor, especially this index, right? And here, when you read these lines, you kind of understand, whether the returns that you are looking at, the 3-year rolling returns, are they statistically significantly or different or not, is something that you can notice here. The effect size tells you while the difference is statistically significant, is the magnitude high or medium or low, or small or medium or large, right? So the magnitude of the difference in this case seems to be small. And similarly for 5-year rolling return, you have these numbers. P-value kind of tells you the significance, and then you also have a t-statistic in case you want to look at that number as well. Here as well, you can see that the magnitude of difference in case of a 5-year rolling return comparison is also small. But when you look at a 7-year rolling return, you see that the difference is actually negligible. Okay, so this is the entirety of it. While there are a lot of things to look at, and we ideally want to make it as comprehensive as possible, so that you're not leaving any stone unturned. But like Shekhar mentioned, the 3 things that you want to look at, or 4 things that you want to look at, are returns, primarily rolling returns, risk, in terms of volatility, then drawdowns, then the last thing you also want to look at is the consistency, right? How is it performing over time, than just looking at the recent period. Now, I just want to quickly also show another example. I'll not go through all the metrics again, but just want to show how do you work in terms of adding more and more indices. By the way, if you just want to look at one index, how do you look at it, right? Let's say you remove this index here, right, and you trying to configure weights. It says that please select at least one index for both strategy, right? So you can't look at just one index alone. You always have to select the other strategy here as well. So which I know is painful for you, but there is a jugaad. I think some of you can guess it. So if you just want to look at one index throughout, just select the same index here as well, right? And you run the weighted backtest, and what will happen is, though you will see 2 different numbers here, you will actually see that it is the same number. So let me just give it a second to see that. See, here I selected 500 value 50, and it's exactly the same. And you see these 2 curves are kind of merged into one. So this is how, if you ever want to look at just one index at a time, you can also do that. Now, let me add a bunch of indices. Let's say I add small cap 250, mid cap 150, and compare that with, let's say, 500. Okay, so here I added more than one index, and here I'm just keeping one index. So the minute you do that, so if you add 2 indices, this will break into 2 weights, right? So when you add another index, let's say Nifty 50, you see that this tool automatically creates 3 weights for you because you have 3 indices. When you add up these weights, make sure the total weight is 1. So let's say if I take just small cap or mid cap 150, if I mistakenly just put 0.4 here and 0.5 here and run the backtest, it will not work because it throws an error saying that the sum of weights should be 1.